Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Greater Bay Area AI Computing Tech Co. Limited Annual Report. Greater Bay Area AI Computing Tech Co. Limited offers a diverse range of businesses and services. At its core, the company develops and sells residential properties as well as commercial trade and logistics centers in mainland China. In addition to property development, the company provides value-added business services that include property management and rental services. The company also extends its offerings to investment management and finance leasing services. This comprehensive approach enables Greater Bay Area AI Computing Tech Co. Limited to cater to various needs of its clients, from property ownership to financial solutions. With a strong presence in Shenzhen, the People's Republic of China, the company has established itself as a significant player in the region's real estate and finance sectors. Greater Bay Area AI Computing Tech Co. Limited, market capitalization of $11 billion, is materially smaller than most of its industry peers of roughly $17 billion. Greater Bay Area AI Computing Tech Co. Limited trades at a higher price-to-earnings ratio of 131 times and a higher price-to-book ratio of 1.89 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 99% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be attributed to several key factors. On the growth side, the acquisition of Tiandan Data in October 2025 contributed significantly to revenue, generating approximately RMB 616.7 million. Additionally, the exponential surge in global demand for AI computing power services drove revenue growth, with this segment accounting for a substantial 85.7% of total revenue. The integration and delivery of high-performance server equipment also saw an increase in revenue, rising by RMB 382,700 from RMB 1,602,700 to RMB 1,985,400. Furthermore, infrastructure services revenue increased by RMB 359,426. These factors collectively contributed to the growth in revenue. On the other hand, the primary drivers of revenue decline were largely due to strategic portfolio adjustments and macroeconomic conditions. The company experienced a significant decrease in revenue, with a 61.5% drop compared to FY 2024. This was also reflected in the infrastructure business revenue, which decreased by RMB 1,217,906,000 from RMB 1,602,700,000 in 2024 to RMB 385,794,000 in 2025. The decline in sales generated by individual segments can be attributed to various reasons, such as the discontinuation of trading business segment, decrease in sales of properties revenue, and decrease in property management service income. These factors collectively contributed to the decline in revenue. The company's net income and profit margins underwent significant changes between FY 2024 and FY 2025. In FY 2024, the company reported a net loss of approximately RM 1,834.6 million, indicating a substantial financial strain. However, in FY 2025, the company turned its fortunes around with a net profit attributable to shareholders of approximately RMB 73 million and RMB 107.1 million. This marked a significant improvement in the company's financial performance. The increase in profit margins was also noteworthy. The gross profit margin increased by 764% from FY 2024, RMB 52.5 million, to FY 2025, RMB 401.1 million. This substantial jump suggests that the company has successfully implemented cost-cutting measures and improved its operational efficiency, leading to higher profitability. The company's financial performance indicates a consistent generation of positive operating cash flow. This trend is evident across multiple pages of the report, with explicit statements confirming the company's ability to generate cash from its operations. The data provided on page 241 and page 243 further supports this claim, showing significant positive cash flows in RMB terms. The repetition of this information throughout the report suggests a strong financial position for the company. Additionally, the statement on page 294 implies that this trend is expected to continue into 2025. Overall, the evidence presented indicates that the company is indeed generating positive operating cash flow. The company's debt level has undergone significant changes over the past year. Total debt has decreased by approximately 38%, from RMB 5,728 million to RMB 3,559 million. This decline is largely driven by a substantial reduction in senior notes, which plummeted by 97% to RMB 111.1 million. Bank loans and other borrowings also saw a notable decrease of 47%. However, lease liabilities have increased significantly, rising from approximately RMB 0.5 million to RMB 2,208.5 million. In terms of interest expenses, the company has experienced a decline in finance costs, decreasing by RMB 3 million from FY 2024 to FY 2025. Interest on bank loans and other borrowings also decreased, falling from RMB 130,420,000 to RMB 59,301,000. Furthermore, interest on senior notes saw a substantial decrease of RMB 96,441,000. The overall trend suggests that both debt level and interest expenses have decreased significantly over the past year. This reduction in debt is likely to have a positive impact on the company's financial health and stability. The performance of various segments and regions within the company has been mixed. In terms of specific segments, the AI segment saw a revenue increase of 14.9% in 2025, while the infrastructure services segment experienced a significant surge with a 100% revenue increase in the same year. However, the trading business segment struggled, reporting no revenue in 2024 and only RMB 88,396 in 2025. On the other hand, certain segments performed poorly. The high-performance server equipment segment saw a decline of 19.1% in profit/loss for 2025. Additionally, the supply chain and partners segment was noted to have performed poorly overall. In contrast, the customers and employees segments were highlighted as performing well, with the environment segment targeted to improve by 2030. It is worth noting that no specific performance metrics were mentioned for China's major business segments or any regions in general. Overall, while some segments showed significant growth, others struggled, indicating a need for improvement across various areas of the company. Management is emphasizing the company's strategic positioning as an AI computing power infrastructure operator, with a focus on constructing 100,000 GPU superclusters. This indicates a significant investment in AI infrastructure to drive growth and innovation. The company aims to create a collaborative industrial ecosystem that fosters mutual growth and sustainability among stakeholders. It will prioritize infrastructure business in mainland China, AI computing power technical services, and high-performance servers. This approach suggests a commitment to long-term sustainability and adaptability in the face of climate-related challenges. Management acknowledges the impact of climate change on the company's financial position, performance, and cash flows over the next decade. To mitigate this risk, it aims to maintain resilience and operational effectiveness during the transition to a low-carbon economy. The company also supports China's goal of reaching peak carbon emissions by 2030 and achieving carbon neutrality by 2060. In addition to its AI-focused strategy, the company is diversifying into new areas such as AIDC construction and operations, and integrating high-performance server equipment. This expansion into related services and technologies suggests a commitment to innovation and growth through strategic diversification. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the financial records indicate that the company has indeed paid out dividends, as mentioned on page 187 of the report. This suggests that the company's management is committed to returning value to its investors. In addition to paying dividends, the company has also engaged in share buyback activities. Specifically, it is noted that the company bought back shares on 3 separate occasions: October 2024, October 2025, and December 2025. These transactions involved issuing new subscription shares to existing shareholders or allotting them to a third-party entity, Champion Road Group Limited. The aggregate number of shares bought back during these periods totals over 600 million. Concerns about inventory buildup and supply chain disruption are valid. The company's write-down of inventory has increased significantly from RMB 643.1 million in FY 2024 to RMB 667.8 million in the current year, indicating a potential issue with inventory management. Furthermore, the real estate sector adjustments have led to tightened industry liquidity, causing a temporary contraction in market demand and putting pressure on inventory destocking. This has resulted in a heightened risk of supply chain disruption. To mitigate this risk, the company has established multiple supplier channels across different regions, reducing its dependency on a single supplier. However, despite these efforts, physical risks such as floods, typhoons, and extreme heat remain concentrated in the company's worksites and operational assets. This poses a significant threat to supply chain continuity and highlights the need for further risk management strategies. That concludes the financial summary for Greater Bay Area AI Computing Tech Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.